Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit each trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:49 a.m. Central Time, and I am recording this in preparation for the market day of January the 26th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive right in. And to our morning report, overnight action across the key U.S. financial futures markets was generally weak, down about 1/3% across the four broad market indices. Crude oil was probably the biggest mover, down about 1%. This is an inflection off of what came out of Greece, with the leftists looking to either control or certainly have a dominant role in the parliament there. And that, of course, has impact on the euro, which has impact on the dollar, which has impact on crude oil. This is all interrelated. But anyhow, crude oil showing significant weakness in the overnight. Gold also down almost 1% at a net change of 11.8 at the time of this snapshot. In terms of our overseas markets, we have not anything terribly exciting. China was up almost 1%. We have Germany up 0.54%, United Kingdom down 0.36%, so kind of mixed across Europe. So don't seem to be responding to the election out of Greece in any significant way at this point in time. In terms of the macroeconomic reports for this week, there's really nothing for Monday with direct U.S. importance. On Tuesday, though, we do get heated up. We do have core durable goods, flash services, consumer confidence, new home sales. Most important, though, keep in mind that on Wednesday we have the all-important FOMC statement, Fed funds rate. We could see the markets very much influenced by that impending report. And certainly trading going into the day on Wednesday could go sideways until that report comes out. So that is absolutely a red flag report for this week, and probably the most important thing that happens in the whole week in terms of anticipated and planned. In terms of our market condition, some of the things that are happening, obviously our volatility is calming quite a bit from the run that we had in the first couple weeks of the trading month. Short-term VIX is now down to a 16.08. Our historical implied volatilities are all basically around the halfway or lower mark. We've also seen, in terms of standard deviation moves, significant calming across our markets. We had quite a run there. We went about 10 trading days in a row, which we had a significant intraday range, and that has clearly changed in the last few trading days. In terms of our daily report, a lot of changes here since our last broadcast. We do have ourselves back at a intermediate term phase opinion of phase 3. Basically higher highs and higher lows is the expectation. Our portfolio trader posture has been upgraded to confirmed uptrend, and our active trader market posture does call for new short-term and intermediate-term bullish trades. So everything is kind of back to normal at this point. Along with those opinions, you do have position size opinions, which would say that long side portfolio exposure can be up to 100%. And from a volatility standpoint, also up to 100%. So quite a bit of improvement across the scale there. From market timing, really quite neutral on the 1-day and 3-day. The FOMC announcement will likely provide the energy in which to knock us out of that neutral stance. Current market forecast across all 4 of our broad indices is now bullish. We are above 50. And I think that one's wrong. NASDAQ is wrong. I'll have to update that. NASDAQ is bullish, but all 4 of these are bullish and are all above a 50. So everything has greatly improved there. Our hedge warning status has dropped to a 0, which is normal, confirmed uptrend. All of our volatility metrics have basically come back and reset. Everything is in kind of standard position. One thing to kind of keep in mind, while we certainly have called for higher highs, higher lows is kind of our posture. Really, if you get into the daily charts, SPX, the RUT, the NDX, we really have similar highs and similar lows and are in the middle of either a complex correction or a range action. So until we really get a true breakout above these similar highs or similar lows, we really don't have a resumption of the prior intermediate bullish trend. So keep that in mind. We really have been quite sideways and have not established any real significant move compared to what we had in 2014 as of yet. Terms of current distribution days, the SPY we're at 3, NASDAQ at 1, so fairly kind of normal conditions there. In fact, we really don't have anything on any of our metrics at this point, from volatility, from trend status, from any of these different things that we look at that tells us that there's any warnings to be concerned about with respect to our hedge status. So this is about as normal as it gets. Obviously, if new information comes in, we will upgrade our opinions, but really this is what you look for in establishing new short-term or intermediate term, or even for that matter core portfolio positions. This is really as clean a picture as you're going to get. VIX phase obviously is actually trending down. You need to update that as well. Option income strategies. The VIX is now inside the acceptable volatility window and is conducive to option income strategies. I know I have one I'm planning on putting on today myself. Let's see. In terms of quite a bit of change in our point and figure intermarket outlook. You notice that a lot of changes came into play this last week with new direction for the dollar oil ratio. Consumer staples has, I believe that was a new target in that case. Also notice that the emerging markets have started to show some life. For so long, the emerging markets were something to avoid or maybe put on bearish trades, but there's definitely something stirring in the emerging market, so you might want to take and put some attention to that. India, China, in particular, are of note. And also on our relative rotation graph, notice biotech, semiconductors, those have heated up significantly. Now, we've been talking about utilities and real estate, and certainly whether you're talking about U.S. real estate or international real estate, both are showing some good action, and that continues to be true. Been talking about retail, but we've also started to see some real movement in XBI and XSD, so something that you might want to take a look at. Perhaps of concern, and we'll see this on our next in our market posture, is the financials. In terms of market posture, our financials clearly continue, along with energy, to be the most disturbed sectors, and it's really quite difficult for the broad market to do a significant bullish run without the participation of the financial sector. So this is perhaps one of our warning signs in terms of where are we going. Materials obviously has improved, but these two these most high beta, and indeed we look at percent change, utilities continues to be at the top. We continue to see these sectors that are high beta are the ones that are still struggling the most. And if we're really going to take off, these have got to kick in. We've got to have financials, energy, materials, these high beta risk on come into play. If you think of this as a branch with the trunk as your dollar and your bonds, and your low beta as the thicker part of the branch, and the high beta as the thinnest part. Well, the thinnest part can whip the most in the wind. That means that they'll go up the strongest when things are going well, but they'll also reverse the hardest when things are in stress. Well, for us to be truly all-out bullish in our forecast, we're going to have participation by these high beta sectors come into play. And you see this from our market posture and our relative rotation. Some of these where we, for example here, regional banking, one of the poorest performing. For those sectors to come online and be contributing to the bullish action is really when we'll have significant movement, and we'll break out of what is probably a trading range at this point and see something of more significance. Current industry sectors: retail, railroads, internet, transportation, and healthcare are current top 5. Little bit of a reordering there from our last report, but still pretty much the same players that we've been focused on for a number of weeks. So as you are looking at putting on new short-term or intermediate-term bullish positions, certainly those are the industry groups that you want to pay particular attention to, and will likely have the most staying power, especially if we're ranging. These are the sectors that will likely be the persistent productive producers for you in this kind of market condition. So, as always, greatly appreciate your liking us on social media. Feel free to comment on our Facebook page. You can also, of course, send us questions or other comments at support@falconglobaltraders.com. More information about our live trading rooms, including our equity and ETFs room, our options room, or our futures live trading room, all of which have 2-week free trials, all available off the website at falconglobaltraders.com. Greatly appreciate everything that you have in terms of your feedback to us and helping us become better every day. Disclaimers as usual. Hit the pause button if you need more time to review the disclaimers in depth. And as always, we greatly appreciate all of you each day at the Falcon Global community. Thank you.